Hello everyone, my name is Fafunsho Elias, and according to the title of this video, I'll be talking to you guys on one of the ways to save on taxes, which is by opening a 401k account. But before I jump into the video, please make sure you hit that subscribe button, hit that like button, and turn on the notification bell, as you'll be helping in making the YouTube algorithm to recommend this video to other people, and they can also gain value just as you are doing now. So back to the video. What is a 401k? So a 401k refers to section 401k on the IRS code, which authorizes company-sponsored retirement plans. It was started in 1978, and the entire intention was to defer employee-earned income into retirement. So what this means is that just as the government is taxing the income of employees, they also now created a plan whereby these employees can save money for their retirement. And the period whereby they save this money for their retirement, the money they save is not taxed. So how does this work? You can contribute up to $18,000 into the 401k account, or up to $24,000 if you are above the age of 50. This money is not taxed until after the age of 59 and a half. That's the period of time that is specified for your 401k account not to be taxed. And hopefully by that time, you'll be in a lower tax bracket than you are now. And what this means is that, like right now, if you are not saving your money in your 401k account, whatever the percentage of the tax is, by the time you now start saving a 401k account and you reach the age of 59 and a half to now start to withdraw this money, hopefully, if the tax is lower, then you'll be able to get the profit from off the difference of the tax percentages, if you get it. So here's a practical example. If you make $100,000 in a year and you save $18,000 in your 401k account at, let's say, 25% tax bracket, that means you are saving $4,500 on taxable income. And that's extra $4,500 that you can invest and work for you on the long term, right? Instead of that money being deducted or being taxed if you didn't have a 401k account. But now that you have a 401k account, you are saving $4,500, which when invested is working for you on the long term, right? Imagine a space of over 59 and a half years, and you are saving $4,500 for every year in the period of that time. And if the market should perform well, that will be a huge amount of money for your retirement. So now, what are the advantages of having a 401k account? So firstly, you've had, money that will have been taxed. You have that money instead working for you for the long term, and it will be compounding interest over the years. And put in mind that you're betting that by the time you retire, the tax bracket will be lower than what you are paying right now. So how do you go about it? If you're employed, you go to your employer, or you try to find out if they are offering 401k in the company. And if you realize or you find out that they do, you try to set one up and contribute towards it. And sometimes the employer is to offer what they call an employer match. And what this means is that they are willing to match a particular amount that you put into your 401k. So let's say, for example, for every $1,000 that you put in your 401k account, they are willing to match it with extra $1,000. Or for every $2,000, they are willing to match it with $2,000 too. So regardless of what it might be. Now, if you find out that they are offering this employer match, then it's very, very advisable that you key into this. You have to take opportunity of it, because it is literally free money, right? Free extra money. So you key into this, and then you put whatever money you're required to put so that your employer can match it up. And if you are self-employed, you can set up a SEP or solo 401k account. Now, in this scenario, you'll be contributing both as an employer and also as an employee. So when should you contribute to a 401k account? You contribute to a 401k account when you are earning high income, right? So when you're earning high income, you make use of that opportunity to start putting money into your 401k account in readiness for your retirement. Also, if you have high taxes, so if the tax on your income is high, you can also put money into your 401k account, and that's an advantage for you, because every money that you put into your 401k account, it is not taxed until after retirement. And as I explained before, hopefully when you retire, your tax bracket is now low, because that's when you'll be able to profit of the difference of the tax bracket. Also know that if you take money out of your 401k account before the age of 59 and a half, you'll be required to pay a penalty fee of 10%. And on top of that, you also pay tax on that money that you have withdrawn. So now, what are the downsides of having a 401k account? Number one is lack of liquidity. You are not able to have cash at hand. The money you are putting in, you are locking it there for a very long period of time, right? You are contributing that money towards retirement. So once you hit the age of 59 and a half, you cannot take out money from that account. So lack of liquidity in the sense that you don't have any cash at hand from that money. Another thing is the employer 401k fees. So most people don't take note of this. Whenever you are contributing towards a 401k account, it is always important for you to take note of the fees that is being collected on managing the account. So you try to find out. Sometimes it can be 1%, it can be 2%, whatever it might be. It's very, very important for you to know whatever fees they are collecting. So if the fees are high or the fees are low, whatever it might be, at least maybe adjust your expectations towards it. And also note that if you are moving from an employer to another employer, for example, like if you change jobs, some people don't know. When they change jobs, they just think, okay, automatically, I have to like take out money from my 401k account. I have to stop it because of let the job that I'm doing or the organization I'm working for. There are plans whereby you can, roll it over. You can roll over your 401k account or 401k plan into another plan, or you can roll it over to like the next employer that you're going to work for. Number three downside is market risk. Anytime you invest your money, there's always risk. It's not automatic profit every time. Your return may not be as it has been historically, but then know that 401k account, you are cutting off taxes, whatever the market might be, whether the market performs well or the market performs poorly. But in the period of years before your retirement age, comes about or reaches, probably there'll have been good times and bad times too. But most importantly, you're able to save your money on taxes throughout that period till you retire. So on the channel, I'll be dropping more videos about how you can save more money, you can work towards financial independence and financial freedom. Once again, if you have not hit that like button, make sure you hit that like button, hit that subscribe button, and turn on your notification bell, as you'll be helping in making the YouTube algorithm to recommend this video to other people. See you guys in the next one.